$7 trillion. That is what McKinsey projects will be spent on global data center infrastructure through 2030. And most investors are chasing the same 5 names, while completely ignoring the companies that actually build everything those 5 names need. Here is the truth most financial channels will not tell you. The biggest returns in the AI build-out have not come from Nvidia or Microsoft or Google. They have come from the contractors, the equipment makers, the cooling specialists, and the hidden infrastructure companies that nobody talks about. One HVAC contractor turned $10,000 into $220,000 in 5 years. An electrical contractor compounded earnings per share nearly 8 times. A cooling company went from negative margins to 17 times its original stock price. These are not technology companies. They are the picks and shovels of the AI revolution. And the wave is not over. It is still building. I spent weeks mapping every layer of the AI data center supply chain to find these 10 names. By the end of this video, you're going to understand exactly who benefits from $7 trillion in spending and how to think about allocating across all 4 layers of this build-out. If you want to find opportunities before the mainstream narrative arrives, hit that subscribe button right now. This is exactly the research most investors never bother to do. Here is what we're covering. 4 layers of the AI data center build-out. The contractors who physically construct everything. The equipment makers whose products go inside every rack regardless of which chips are in them. The cooling specialists solving a problem that simply did not exist 5 years ago. And the hidden layer of fiber, components, and behind-the-meter power that none of this works without. Let's get into it. Tier 1, the contractors. The hyperscalers, Microsoft, Amazon, Google, Meta, and Oracle, are spending over $700 billion on AI infrastructure this year alone. And somebody has to physically build all of it. Stock number 1, Comfort Systems USA, ticker FIX. Most investors have never heard of Comfort Systems USA, and that reaction tells me most investors have not been paying attention to where the real AI infrastructure money is flowing. Here is the reframe. Comfort Systems is not just an HVAC contractor. It is the company hyperscalers call when they need one company to handle every mechanical, electrical, and plumbing system inside a data center building. The entire interior build-out. One contractor, maximum accountability, and the numbers reflect a complete transformation of this business. Data center customers went from 1/3 of revenue 2 years ago to over half of revenue this past quarter. The backlog reached a record $122.4 billion, nearly doubling year over year. Operating margin more than doubled, return on invested capital sits at 62%, 0 meaningful debt. Those are software company economics on a mechanical contractor. If you had invested $1,000 in Comfort Systems in spring 2021, you would have approximately $22,000 today. A 22 times return in 5 years from an HVAC company. Here is my honest concern. At current valuations, the easy money is behind us. The stock has already reflected much of the data center tailwind. New investors are paying for a story that early investors got at a fraction of the price. My takeaway: the cleanest balance sheet in the entire AI build-out contractor space, record backlog, software-level margins on mechanical work. For investors who want direct hyperscaler construction exposure, this is the highest quality name in Tier 1. Stock number 2. IECS Holdings, ticker IEC. IECS handles the electrical work that brings data centers to life. Cabling, fiber, low-voltage systems, the wires and boxes that connect every rack to every other rack. Revenue compounded at 23% annually for 5 straight years. Operating margin nearly tripled. Earnings per share multiplied nearly 8 times. The stock has returned over 10 times since 2021. But here is what makes IECS the most interesting contractor on this list. The market cap sits around $12.6 billion. That means compared to the scale of the backlog growth happening in their communications segment, there is still meaningful room to compound aggressively if data center construction stays at this pace through 2028. The metric to watch is communications segment growth. As long as that segment keeps printing 35% plus, hyperscaler demand is intact and the runway extends. Here is my honest concern. Electrical contractors operate on thin project margins, and any slowdown in hyperscaler construction spending would hit IECS faster than the larger diversified names. My takeaway: 8 times earnings per share growth over 5 years, 23% compounding revenue. Still small enough to move dramatically if data center construction maintains this pace. Buy on any meaningful pullback. Stock number 3, Quanta Services, ticker PWR. Quanta is the largest pure-play infrastructure contractor in the category. Power transmission, communications, and energy infrastructure work for hyperscalers, utilities, and large industrial customers across multiple sites simultaneously. Here is the number that puts everything in context. Quanta's backlog now sits at over $48 billion. That is bigger than the entire market cap of most companies on this list combined. Management raised full-year revenue guidance into the $35 billion range, and a major portion of that backlog is locked in through long-term master service agreements rather than one-time projects. That is the kind of revenue visibility that provides years of forward earnings clarity. Quanta has publicly disclosed a strategic partnership with American Electric Power, structured to support AEP's $72 billion capital plan, including transmission infrastructure that directly serves the data center market. Revenue compounded at 20% annually for 5 years, and the stock has returned more than 7 times since 2021. Here is my honest concern. At Quanta's current scale, further compounding requires increasingly massive project wins. The law of large numbers eventually slows everything. My takeaway: the credibility anchor of the entire AI build-out, $48 billion in backlog. Revenue visibility locked through master service agreements. If hyperscalers are spending real money on real construction, Quanta catches a meaningful share of every dollar. Tier 2, the equipment makers, stock number 4, Powell Industries, ticker POWL. Powell designs and builds the high-voltage switchgear that controls the flow of electricity inside data centers. Without their equipment, none of the power reaching a data center can be safely distributed to the racks. The transformation story here is one of the most dramatic on this entire list. In fiscal 2021, Powell was essentially break-even with near-zero operating margins. 4 years later, operating margin has expanded to nearly 20%, while revenue more than doubled. The company did a 3-for-1 stock split because it ran so far, so fast. The most recent quarter confirmed the trend continues. Record $1.6 billion backlog. New orders up 63% year over year. The highest quarterly bookings in over 2 years. Here is my honest concern. Powell is a smaller company, and the high-voltage switchgear market will eventually attract competition as margins improve. Monitor order growth carefully. My takeaway: near-zero margins to 20% in 4 years. Record backlog, 63% order growth. This is what an industrial company looks like when it finds the right market at the right moment. Stock number 5, Eaton Corporation, ticker ETN. Eaton makes the power management equipment that goes inside every major data center on Earth. Switchgear, busways, UPS systems, electrical distribution gear. The products specified in every greenfield hyperscaler build. The scale here is extraordinary. Total data center orders were up over 200% year over year in their most recent quarter. The Electrical Americas backlog reached a record $13.2 billion. Management noted that the data center construction backlog represents over a decade of normalized build rates. Eaton also acquired Boyd, a leading liquid cooling company, expected to generate $1.7 billion in annual sales, with over 80% coming from data centers. That acquisition positions Eaton at the intersection of power management and liquid cooling, two of the fastest-growing categories in the entire build-out. Operating margin expanded from 19% to over 24% in 5 years. Earnings per share roughly tripled. The stock returned more than 3 times since 2021. Here is my honest concern. At $167 billion in market cap, Eaton is the largest name on this list. The upside percentage moves will be smaller than the smaller cap names. My takeaway: the most defensible position in Tier 2. Every data center, regardless of chip vendor, needs Eaton's power management products. This is the blue chip anchor of the AI equipment layer. Tier 3. Cooling. The new generation of NVIDIA AI racks pull 132 kilowatts of power, nearly 10 times what a traditional server rack pulls. Air cooling cannot handle that. Liquid cooling is the only answer. Stock number 6, Modine Manufacturing, ticker MOD. Modine designs and builds the liquid cooling distribution units, immersion systems, and thermal management gear that the new generation of AI racks cannot function without. The financial transformation here is the most dramatic in the entire basket. 5 years ago, Modine was a struggling auto supplier with negative 5.4% operating margins, literally on the chopping block for acquisition. 4 years later, operating margins flipped to positive 11%. Earnings per share moved from a loss of over $4 to healthy profitability. The stock returned roughly 17 times. The most recent quarter showed the momentum is intact. Climate Solutions revenue grew 51% year over year. Data center sales alone were up 78%. Here is my honest concern. Modine is the smallest pure play in this video and carries more volatility than the larger names. The auto exposure that remains creates drag in a weaker consumer environment. My takeaway: negative margins to 17 times the original stock price. Data center sales up 78%. The purest cooling play in the entire basket, and the transformation story is not finished. Stock number 7, Carrier Global, ticker CARR. Most investors dismiss Carrier as a slow-moving HVAC company. The most recent earnings numbers should change that perception immediately. Global data center orders were up over 500% year over year. The data center backlog now fully covers their $1.5 billion full-year sales target, with room to exceed it. Carrier is actively working with NVIDIA on cooling designs for next-generation AI infrastructure. Their integrated data center offering, combining precision chillers, coolant distribution units, and building management software, booked $300 to $400 million in orders within its first year of availability. Here is my honest concern. The 5-year stock return is the lowest in this basket at roughly 55%, and operating margin actually contracted through recent acquisitions. Carrier needs to demonstrate margin recovery to justify a higher valuation. My takeaway: 500% data center order growth, active NVIDIA collaboration. The market has not priced this transformation in yet. For investors who want cooling exposure at the most reasonable valuation in the basket, Carrier is the contrarian opportunity. Tier 4, the hidden layer. Stock number 8, Belden, ticker BDC. Belden makes the data center fiber, high-speed interconnects, and cabling that physically connects GPUs inside hyperscaler campuses. Without Belden's infrastructure, the racks cannot communicate. Revenue compounded at 9% annually. Operating margin expanded from high single digits to over 11%. The company moved from net loss to solid profitability. And here is the transformation that makes this story suddenly much more interesting. Belden just acquired Ruckus Networks for $1.8 billion. A single acquisition that adds Wi-Fi 7 access points, enterprise switches, and cloud management networking to a company that was already running the fiber backbone. In one move, Belden goes from cable company to full-stack networking infrastructure play. The market hit the stock on the deal. While every other name in this basket is making new highs, Belden sits at one of the cheapest forward multiples in the group at 15.7 times forward earnings, despite delivering 11% revenue growth. Here is my honest concern. Acquisition integration is always a risk, and the market's skepticism about this deal is not irrational. Watch integration execution carefully before sizing up significantly. My takeaway: the cheapest forward multiple in the entire basket. Full-stack networking transformation from a single acquisition. This is the contrarian value setup in the hidden layer. Stock number 9. Mueller Industries, ticker MLI. Mueller is the only vertically integrated manufacturer of copper tube, brass rod, and forgings in North America. They supply critical cooling components into the plumbing, HVAC, refrigeration, and industrial systems that every data center depends on. The most recent quarter was extraordinary. Net income jumped nearly 52%. Diluted earnings per share climbed to $2.16. Gross margin expanded nearly 300 basis points. Mueller also raised their quarterly dividend by 40%. The 6th consecutive year of double-digit dividend increases. That is the kind of capital return move management makes when they have high confidence in forward cash flow. Revenue compounded at 12% annually for 5 years. Operating margin roughly doubled to over 21%. Earnings per share multiplied more than 5 times. The stock returned more than 6.5 times since 2021. Here is my honest concern. Copper is a commodity, and Mueller's margins can compress when copper prices move adversely. This adds a layer of cyclical risk not present in the software-oriented names. My takeaway: 6.5 times return since 2021. 52% net income growth in the most recent quarter. The 6th consecutive year of 40% dividend increases. Mueller is the income-generating hidden infrastructure play in the basket. Stock number 10. Bloom Energy, ticker BE. Bloom designs and manufactures solid oxide fuel cells that generate electricity on-site behind the meter without waiting for utility grid connection. For data centers that need power immediately and cannot wait years for grid infrastructure, Bloom is the only public pure-play solution. The most recent quarter came in well ahead of consensus, revenue up 130% year-over-year, gross margin reaching 31.5%. Oracle agreed to procure up to 2.8 gigawatts of Bloom's fuel cell systems, with 1.2 gigawatts already contracted. More than half of Bloom's data center backlog now comes from hyperscalers, neoclouds, and co-location providers beyond Oracle. Total contracted backlog sits at roughly $20 billion. Here is my honest concern. Bloom's fuel cells require natural gas, and the technology carries higher upfront costs than grid power in areas where grid access is available. The thesis depends on grid constraints persisting in the highest demand data center markets. My takeaway: 130% revenue growth, Oracle anchor customer, $20 billion contracted backlog. For investors who believe the US power grid cannot keep pace with AI data center demand, Bloom is the most direct solution available in the public markets. Let me bring this all together. 10 stocks, 4 layers of the AI data center supply chain, and a $7 trillion tailwind that McKinsey projects through 2030. Here is how I would allocate across the 4 tiers if starting fresh today. 30% to Tier 1 contractors. Comfort Systems, IECS, and Quanta have the most direct hyperscaler exposure and the cleanest balance sheets. 25% to Tier 2 equipment. Powell and Eaton combine capital efficiency with the largest single backlogs on the list. 20% to Tier 3 cooling. Modine and Carrier are the highest growth subsegment of the entire build-out. 25% to Tier 4 hidden layer. Belden, Mueller and Bloom are where the contrarian value setups and the rare income opportunities live. The concentration goes highest where the balance sheets are cleanest and hyperscaler exposure is most direct. The concentration goes lower as volatility increases further down the supply chain. Here is the investing truth I want to leave you with today. The biggest returns in the AI build-out have not come from the companies everyone talks about. They have come from the HVAC contractors and the electrical workers and the copper tube manufacturers that nobody follows and nobody covers. $7 trillion is going to flow through this supply chain over the next 5 years. Most of it will flow through companies that never trend on social media. That is not a reason to avoid them. That is the reason the opportunity exists. You just mapped the entire supply chain. Use that knowledge. Disagree with any of my picks? Tell me in the comments. Which layer would you allocate to first? Which name do you think I am wrong about? Subscribe for weekly research on where the real money is flowing in the AI build-out. No sponsors, no fluff, just the analysis. See you in the next one.